explainer. Today, we're diving into something that is honestly both fascinating and a little bit alarming. And the best part? It's entirely driven by hard data. We're going to put the Italian stock market under the microscope, specifically the Ftse Mib index and its blue-chip constituent assets. We're tracking indicators that are screaming about extreme valuation levels. In fact, according to recent quantitative models, we might literally be staring down the barrel of an imminent and potentially catastrophic price correction. I'm super excited to guide you through this data so we can decode exactly what the math is trying to tell us. So let's get right into it. On the surface, the Italian equity market projects this incredible illusion of stability and massive scale. I mean, the total market capitalization stands at a towering 1,572.52 billion euros. That is a staggering amount of wealth. When you see a number like that, it's totally natural to assume the foundation is rock solid, right?
But that brings up a really crucial question. Is all this wealth basically just a giant house of cards? Are these sky-high valuations hiding a massive systemic vulnerability? We aren't going to rely on gut feelings or opinions today. We're going straight to the source, looking strictly at quantitative models, extreme value theory, and contagion simulations to figure this out.
Here's our roadmap for today. We're going to hit 4 main points. 1, the valuation peak. 2, quantifying the black swan. 3, the fire sale contagion. And finally, 4, historical crash probabilities. Part 1. The valuation peak, extreme overvaluation, and necessary corrections.
Okay, you know a healthy historical benchmark for a standard price-to-earnings, or PE, ratio usually sits somewhere around 12, right? Well, take a look at these outliers because they're absolutely wild. STMicroelectronics is leading the pack with a massive PE of 329.9. Avio is sitting at 84.6, Telecom Italia at 56.3, and Brunello Cucinelli at 40.9. These assets are trading at valuations that are, quite frankly, entirely divorced from historical reality.
And this brilliantly illustrates the terrifying reality of what happens if the market actually decides to return to normal. Look at the sheer gravity of the price normalization required just to bring these stocks back down to that standard benchmark PE of 12. Avio would require a devastating correction of about 85%. Telecom Italia would need a drop exceeding 70%, and Brunello Cucinelli would have to shed more than 60%. We're not talking about a minor market dip here. This is a massive structural price normalization just to return to baseline logic.
Moving on to Part 2, quantifying the black swan, measuring tail risk.
Now, when we say tail risk, we aren't talking about your everyday run-of-the-mill market bumps. We're talking about the expected shortfall at a 99.9% confidence level. Put simply, this is the mathematical worst-case scenario. It measures exactly how catastrophic a single daily loss could be during an extreme, rare market crash. When we apply this to the hard data, the severity is pretty staggering. For the Ftse Mib index as a whole, the 99.9% expected shortfall is 10.8%. That means, in a severe tail event, the entire index could lose over 10% of its value in a single day. But it gets so much worse for individual high-beta stocks. Look at the major banks. UniCredit shows a potential daily wipeout of 37.8%. Banca Monte dei Paschi di Siena reaches a catastrophic 38.7%. This is the actual quantitative magnitude of the downside risk we're dealing with. And it gets crazier, because something called jump contribution to variance actually tells us how these stocks might lose that value. For assets like Mediobanca, STMicroelectronics, and Iveco, over 80% of their variance comes from sudden, extreme price jumps. Basically, the volatility here isn't a slow, steady, predictable downward slope. It's driven by abrupt, severe price breaks. Think of it like walking off a cliff edge rather than walking down a hill.
Section 3. The fire sale contagion, market collapse risk. Let's walk right through this catastrophic domino effect exactly as the data simulates it. It's basically a chain reaction. Step 1. The market takes an initial 10% shock. Step 2. This triggers a black swan panic, projecting staggering, rapid-fire daily capital outflows of 409.11 billion euros. Step 3. Because everyone is rushing for the exit at the exact same time, illiquid assets, specifically noted in the data as Danielian C, completely freeze up. They become almost impossible to liquidate, massively exacerbating the downward spiral. And step 4, the end result of that single 10% shock exponentially magnifies into a massive 57.37% total loss in market capitalization.
Bringing this macro data down to earth for a second, let's look at specific targets. Brunello Cucinelli, Fineco Bank, and Recordati are projected to be among the most severely hit by this contagion, facing tens of billions in potential value loss. But you want to know the most terrifying part? The contagion effects alone, meaning the panic selling itself, not the underlying initial shock, account for nearly 47.58% of that total market loss. The fire sale itself is the real wealth destroyer here.
Finally, Section 4, Historical Crash Probabilities, the Reality Check.
So the crucial takeaway here is that this is not just abstract theory. This quantitative analysis is backed by a massive data set of 3,490 historical observations. Based on those numbers, the historical probability of a crash event, which the data defines as a daily drop of 5% or more, is a highly elevated 13.9%. There is a significant structural probability of extreme losses built right into the DNA of the current market reality. Which brings us to our final thought for today. We've just unpacked extreme PE ratios demanding up to an 85% haircut. We've measured 99.9% expected shortfalls that could push daily banking losses near 40%. And we've seen how a single 10% shock can trigger a 400 billion euro capital outflow and a 57% total market cap collapse through sheer contagion. So I leave you with this. Given the convergence of all these extreme risk factors, are current market levels truly sustainable? Or are we just waiting for that very first domino to fall? Thank you so much for joining me on this explainer. Keep learning, keep questioning the data, and I'll see you next time.